Welcome back to Rand on Real Estate. I'm Greg Rand, your host on 77 WABC. We've been talking about things are turning rational out there in the media when it comes to the housing market. And I want you to stick around because we're going to have in the next segment an interview with somebody who lived and thrived through the Great Depression. And I think his lessons are really, really powerful and interesting and inspiring to people who do not want to let the Great Recession drag them down, who plan to live and succeed despite the storm of negativity around them. So stick around for that. But first, market corrections. Right, one of the things about the media in the last several years is that they don't explain things anymore. You know, nobody explains. That's why talk radio is so great. You have time to explain things. Market corrections are spoken about frequently, and you've seen them. You probably lived through the stock market correction of the early part of this decade where tech stocks were overvalued. People were only concerned with how sexy the website was and didn't care if the company generated any revenues or profits. And so the value of those stocks was way inflated. And then eventually the stampede that was going into tech stocks begins to go the other direction, and that market corrects. And the term correct is very important. What it means is that the market is adjusting to where it belongs. It was incorrect before, and now it's correcting. And we've all just lived through the biggest part of the housing correction, where we know that through the booming 2000s, there was a froth of enthusiasm for real estate. And there was a lot of lending guidelines that got weaker, and people were borrowing more and more money, and everybody believed the market would always continue to go up. And honestly, around 2004, we began to notice a change. I mentioned in the last segment that we used to watch for the end of the bidding war frenzy. That happened at the end of 2004. So we put a flag up at the beginning of 2005 saying the market's changing, something's going on here. Let's begin to change our expansion strategy. Let's begin to, hoard some of our resources and wait for the market to correct. Then we can begin to expand again, which we did. But what that told us was that the marketplace was actually satisfied in 2004, 2005 with the prices. And all the appreciation that happened after that was erroneous. Okay, it was momentum driven. It was low interest rate driven, interest rates that were artificially low. And it was lending guideline driven, meaning people that didn't qualify for the increase in price were able to buy it anyway because the bank was changing their guidelines to allow people to borrow more and more and more. Like, hey, honey, I guess we can afford $7,000 a month in our mortgage payment because the bank says we can. Right? That happened a lot across the country. But what's interesting is that in the New York area, the real estate correction happened here last. Okay, we were all during 2005 into 2006 and 2007. You'd watch the TV, read the newspaper, and you'd hear about the foreclosure trend happening, and it was happening in Arizona and California and Nevada and Florida primarily. New York, it didn't hit here yet. Okay, so for 2.5 years leading up to the economic crisis, the financial crisis of 2008, foreclosures were beginning to really happen in other parts of the country. By the time the real estate market value-wise corrected in New York, by the time our market peaked, it was already 2008. So just a few months prior to the economic crisis of October of 2008, finally people started losing value in their properties in New York, and the defaults just began to accumulate at that point. So what happened next? As soon as the financial crisis hit in October of 2008, the banks and the government, state and federal, began to put moratoriums on foreclosures, meaning if you weren't paying your mortgage, typically you have a certain number of days to go late, 90 days late. Now you go into the foreclosure crisis, and some months later you're served with foreclosure, and the bank's going to take your property back. The whole thing will take around a year, okay? Didn't happen in New York, because as soon as that pipeline of foreclosures began to accumulate, the moratoriums kicked in. So you've heard about the shadow inventory. The shadow inventory, what they mean by that when they say it is an inventory of properties that are going to be coming for sale that for one reason or another are not yet visible. They're not out of the shadows yet. So they're accumulating and piling up. And the biggest part of that is the foreclosure inventory. These are people aren't paying their mortgages. The banks are allowing them to stay there because the banks don't want to take those properties back yet. The moratoriums are now mostly over, but the banks are still kicking the can down the road. Why? They're doing it because they can't figure out how big the financial mess is on their balance sheet until property values hit bottom. In other words, if I take a property back as a bank, I foreclose on it and take ownership of it. If it's declining in value, I can't do the math on what it's going to be worth in the future. And everything about the valuation of my company, my bank, my balance sheet is all based upon what are the assets that I own worth and what are they likely to be worth in the future. So when you're buying into this idea of a free fall, that free fall literally has got you frozen solid, waiting to see a bottom. And once you feel a bottom, like it reminds me, are you scared of sharks? You guys saw Jaws when you were a kid too, right? Whenever I go in the ocean, I could be, I'm 6 feet tall. If I'm in 6 feet and 1 inch of water and I can't feel the bottom, all I can imagine is a shark coming up to get me. I might as well be in 1,000 feet of water, okay, if I'm 1 inch from touching the ground. As soon as my little toes touch the ground, there's a sense of comfort. Same thing with the banks. As soon as they feel the bottom, there's going to be a sense of certainty about what their portfolios are actually worth. And then they're going to begin to take these properties back, foreclose on these properties en masse, because then they want to pull the Band-Aid off. All right? Now, right now, today, our market is hitting bottom. It's happening now. The market is corrected. The appreciation in 06 and 07, even 05 and 04 is all being given back. We're rolling the clock back now to 2003 prices, which I believe is an overcorrection based upon fear and negativity. But what's happening next is the banks, particularly in the New York area, are going to begin to pull these properties back, and they put them on the market for what's called a 30-day price. They assign those properties to a realtor and say, I want that thing sold in 30 days. Give me a 30-day price. Now, today, 30 days is pretty darn fast. What does that mean? They're putting them out with aggressive prices. Not a steal, not half market value, but definitely at or slightly below market value. So the correction is going to become an overcorrection, if it hasn't already, on these specific properties. There's likely to be no fewer than 1 million single-family, multifamily condos in the New York metro area that are going to be taken back. And if you're listening to this on the podcast or on WABCRadio.com, this applies to a lot of parts of the country. The opportunity just happens to be in the Northeast even a little bit more pointed because we are the bottom of the market has naturally been located. We're there right now. When you hear people talk about a double dip recession or the housing market having a W recovery, it's going to happen that next year home prices are going to come down again. And they're going to come down precisely because of all those foreclosures that were dumped on the market with a 30-day sale price assigned to them. So, yes, they're typically lower-priced properties, and they're going to sell a little bit lower. And so you're going to see people all over the media talk about how the real estate market is back in free fall. We're back to the second housing meltdown. They'll be wrong. This was very, very predictable. What I want you to do is start to get your resources set aside, get ready for that. If you want to find foreclosures in your area, the easiest way to do that is to locate the real estate company that the bank hires to sell those foreclosures. You can find them. If you go online searching foreclosures, you'll see certain real estate companies and certain real estate agents will be popping up more frequently than others when there's a foreclosure listing on the market. Contact them. Say that you want to be a client of theirs. Everyone loves that phone call. Hi, my name is Greg and I want to be a client of yours. They love that phone call. Those people are seeing properties coming on the market in large numbers over the next year and a half. And if you're there, you will get first look and you'll have an opportunity to pounce on them. So there is my little nugget of takeaway for the day here. You're listening to Rand on Real Estate on 77 WABC, where we're all about taking advantage of opportunities despite the negativity swirling around us. And after the break, we're going to talk to a gentleman who lived through the Great Depression, whose family did exactly that 70 years ago. Stay with us.